Welcome to Adda 24/7. We are in the BFM Sankalpa series, and in this series, we are covering important theory and objective questions. And today's topic is technology in international banking. Here, the same topic is going on in the paid class also. Everyone, kindly note. Same topic is going on in the paid class. So, if those who are in the paid class, they can follow this series also for the important definitions. Okay, so you guys, those who are watching on YouTube, kindly join the paid classes because in details it is covered, it is covered over there. Okay, so let's start. See here, we'll be doing today the important definitions which are asked in the exam. Very important definitions. Okay, because these definitions I have seen it in so many exams. Okay, so fintech. First definition, fintech means what? Fintech refers to the synergy between the finance and the technology. See here, sometimes they call it fintech and there is a separate word called as techfin also. Techfin. Okay. So techfin and fintech, these are not same words. Fintech means first finance and then technology. Finance plus technology. So basically this company is in finance and then it is using technology. But techfin over here means the company is in technology. Understand the difference? Technology and then it is doing finance. Okay. Now you'll say, sir, what is the difference? Only words are the different over here. See, the difference is like this. Suppose SBI. SBI will fall in fintech. SBI, HDFC Bank, all are banks. They are fintech. They are first finance, then technology. Techfin means what? Google. Google will fall in techfin because it is first technology and then it is giving loans. PhonePe, first it is technology, then it is giving loans. Google, PhonePe. Okay. So these are all the techfin companies. Understand the difference. There is a slight difference in the words, but huge difference in the overall companies. Okay. So finance plus technology. Fintech refers to synergy between finance and technology. Okay. Second one, regtech. Now what is this regtech? See here the words, you can break it up over here. Reg means regulatory. Reg plus tech. So reg refers to regulatory. Technology in regulatory aspects, focusing on automation of the compliance processes for the banks. Right. So automation of the compliance. What do you mean by automation of the compliance? What is this? Okay. See here, I'll give you simple reason, simple logic behind this. Compliance. Let's talk of simple terms like large cash transaction report. Okay. Large cash transaction report means any transaction about 10 lakhs of cash, right? So in large cash transaction report, why has a bank or the employee to report it? As you are having the technology over here, right? So immediately it should be reported, it should catch which is the large cash transaction report and give it, isn't it? So that is known as automation. Similarly for this bill of entry also in trade finance. Now those who have covered this batch, those who are in the batch, they'll understand the SDF form and BF form. BEF. I told you BEF entry is now, BEF report is now removed, right? Why? Because of this automation in the technology. Means bill of entry, whatever is coming in, why should it be reported separately now? Once it's in the customs office, you get it through their system, it is automatically reported to RBI, isn't it? So automation means reducing or removing the manual work in the compliance part at least. Okay, because compliance, always the problem in compliance is if there is a human intervention, always it faces the problem. There is some error, some manual error. So if it is done by machinery, nothing as such. What has happened in clearing now? Isn't it? What is clearing? Clearing is gone now. It's all automation now, isn't it? AI, artificial intelligence. It refers to the simulation of human intelligence in machines that are programmed to think like human beings and mimic their actions. Understand this? Programmed to think like human beings. You will say, sir, how can a machine replace a human being? Of course it can't. No machine can replace a human being. But if you look at your banking activities, What are you doing in the banking? Tell me. If you look at the banking activities, just tell me one answer. Everyone give me the answer in the comment section. Give me one answer. How much part of your job is repetitive in nature? Repetitive means daily you are doing the same job. Same job, same desk, everything. So how much part of your job is repetitive? I'll give you two options. One is almost 90% of your job, and second is 10% of your job is repetitive. Every time it's a new job. Right? Give it in the comment section. Everyone write in the comment section. How much part of your job is repetitive? Correct. Almost 90% of your job is repetitive. 90%. Because daily you can't have new things, isn't it? Will you have daily new challenges? No. We'll have repetitive job almost every day. Some days some new thing comes. Okay, so whatever is repetitive, that can be done by the AI. Here, simple thing is, whatever is repetitive can be handled by the machines. It's that simple. Okay, and mimic their actions. Mimic means rehearse, means do it again. Okay. So AI basically, whatever you are seeing right now, chatbots. What are chatbots? Chatbots we see everywhere nowadays. You go to any site and you see, may I help you? Then you type in that message and then you get chatbots. So now chatbots have gone to the higher level. Now we have something called as chat GPT. So chat GPT, what do you get over there in chat GPT? You get various other things also. Not only this replies, but also you get the artificial intelligence helps you to find the answers to the repetitive questions of the customers. Okay. Next is machine learning. Machine learning refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history, behavioral pattern, advisory services, etc., thereby enhancing the customer experiences with the banks. Now, what do you mean by machine learning? Here, machine learning is known as learning by the machine. It refers to the algorithm by analyzing millions of data sets to provide inputs to the banks. So, learning by the machine means this is called as, there's a word in machine learning that is called as cognitive. This word you will hear many times. Okay, cognitive, TIVE. Okay, cognitive means continuous learning. It refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history. So, whatever are the customer transactions, whatever are the behavioral patterns of that customer, advisory services. So, all these things, basically behavior patterns. Here, if you see the behavior pattern of any customer, at least in the financial field, by that you can definitely govern which products are to be sold correctly to that customer. Okay, thereby enhancing the customer's experience with the banks. So if the customer receives proper treatment or proper advice as per the customer's requirement, then definitely what happens? In that case, the customer will stick more to your bank rather than giving some vague. Means, for example, I'll give you. Suppose if any customer is requiring, let's say, loan. Okay, he is facing some financial problem, and you are trying to pitch to that customer insurance or mutual fund. These are investment products. So will that customer come for this mutual fund or investment with you? No. That customer requires a loan, so you have to pitch in the loans. How will you know whether that customer requires a loan or not? Through his or her behavioral pattern. Okay, behavior pattern means if that customer has asked for the loans, or if there is huge cash withdrawal or transfers from that account. So that is all captured under AI now and machine learning. Okay, so it refers to the usage of algorithm. Remember this word algorithm. What is algorithm? Algorithm is a set of computer programs. Okay, done computer programs. Okay, which make this machine think on the repetitive jobs. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting latest updates on JIB and CAIIB. Number one. Number two, you will be getting all the free YouTube series on JIB and CAIIB. So subscribe to it, click on the bell icon, click on the like button, click on the share button, share it with your friends, isn't it? What is big data and data analytics? See here, big data deals with the data sets that are too large or complex to be dealt with the traditional data processing application software. Now, what do you mean by this? See here, many times in your computer itself, we see our own computer, your home PC it might be, or in your bank PC also. The computer operator or the admin guy, systems administration, when that person checks your computer and he or she says your data is too much loaded, your server or your CPU does not support it, your laptop doesn't support it, memory is too much gone. What is that? What is that person saying actually? That person is talking of big data. See here, every machine has its own capacity. Okay. Suppose if I want a huge data analysis of entire banking industry, I can't keep it on a single PC or even a simple server. For that, huge servers are required, right? So big data deals with data sets that are too large or complex to be dealt with by traditional data processing application software. Okay. Big data is advantageous where volume, variety, and velocity of the data is huge. Now understand the three words, very important. Okay, volume, variety, and velocity. Velocity means speed. We require huge speed. Okay, science graduates might understand this. Okay, velocity is speed. So volume, variety, and speed. All the three things are required and they are huge. Volume is huge means if you consider SBI, what will be the volume? If you consider your own bank, forget SBI, your own bank, what will be the volume? Per day volume. It will be huge. So a server needs to cope up with such big volume. Variety. There are thousands of transactions, variety of transactions. So all the variety needs to be captured in your system. Similarly, velocity, speed. If you imagine in the bank, if when you are using your system and if it takes around 1 minute to answer, even 1 minute is a long time in front of that customer. Waiting for 1 minute is a huge time. Okay, so that's why it needs to be at a huge speed. That's why we have all these 4G, 5G, 6G, all these things. Okay, got it? Data privacy and digital privacy. Now, what is this data privacy? See this. These words many of you might be knowing now by now, isn't it? Privacy means secrecy, right? Digital privacy, same. Okay, digital and data both mean one and the same thing. So data privacy or digital privacy refers to the protection of an individual's information that is used or created while using the internet on a computer or a personal device. So what do you mean by this? Refers to the protection of individual's information. Okay. Now what all information can the individual have? Individual will be having various informations like name, mobile number, that is common thing, address, right? But like graduate, what is your education level? Then what is your family size? Are you holding any assets, car or anything? Okay. Plus, have you taken any loans? So these are all the individual information. Remember, individual information can be of two types. Always remember, it will be of two types. One is static, and second is dynamic. Okay. Dynamic. Static means what? Which does not change. Means what? Your name, generally your name, your address or your Aadhaar number, these don't change. PAN number, they don't change at all. What is dynamic? Are you holding a car? Are you holding some loans? These are all dynamic things, right? Education level is static generally, because once you are educated, you won't change your education. Yeah, generally I'm talking, huh? Somebody can do the changes in that also, okay? So static and dynamic means that, okay? Refers to the protection of individuals' information that is used or created while using the internet. While using the internet means whenever I fill up any form for Google or if I fill up any form for your bank, online form. So if that form, it gives my all the details and that is breached, that is shared by your bank, let's say, with someone else. So what is that? That is affecting my privacy, isn't it? While using the internet on a computer or a personal device. Personal device means anything related to computer or mobile also. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the Premium study material plus live classes, ebooks, tests, whatever we require for clearing the JIB and CIB, we'll be getting it over here. So that's why download it right now. Okay. Data breach. What is data breach? Sure. Just now we talked about data privacy. Importantly, remember these are all the important questions, and you'll get some of them, at least 2 or 3 of them, two at least out of this series, whatever we are talking right now. Today's session, you'll get at least 2 1-mark questions in your exam. Okay. So now you know, everyone among in CIB knows the difference between 1 mark, the importance of 1 mark. The difference is 49 and 50, right? 49, 50 is cleared and 49 is not cleared, isn't it? So data breach. Data breach refers to the security incident in which malicious insider or external attackers gain unauthorized access to the confidential data or the sensitive information, such as medical records, financial information, or personally identifiable information. Now, data breach means what? Just now we discussed about the static and dynamic, right? Dynamic means what here? Generally this dynamic information is very sensitive, because static information generally everyone knows. Where are you staying? What are you doing? Okay, all these things which don't change. This generally everyone knows. What is important is dynamic, and all the companies want this dynamic data, because it is changing. It is changing, and what happens? Your habits are changing accordingly. So data breach refers to security incident in which the malicious insider. What do you mean by malicious insider? Insider means that person working in the bank itself. That person compromises the data and gives it to some other external company or external attackers. External attackers means what? These are all those attackers, these cyber attacks. Okay. So these cyber attackers or these insiders gain unauthorized access. Unauthorized means even the banker can get unauthorized access. Suppose if you are in the branch, do you have the access to the head office data or sensitive data, balance sheet and everything? Do you have access to that? No. That is, if you have access, you are in the branch, you have to get access only to your part. So that is known as unauthorized data. If you get information about something else which is not required by you, so that is known as unauthorized data. Okay. So unauthorized access to the confidential data or the sensitive information, such as medical reports, financial information, or personally identifiable information. So medical reports, sure, that's what I said. These all things are dynamic. If you check this, these are all dynamic, right? Dynamic means what? They go on changing. Dynamic, right? Medical reports, they go on changing. Financial information changes. Personally identifiable information, right? So these are all the changing things. Okay. So mainly the access to this is required by the companies so that they can sell the various products to you. Okay. P2P lending means a financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on the investments. P2B. P2B means peer-to-peer. This is known as peer-to-peer, or in simple you can call it peer-to. It's two, peer. In simple way, peer. You can call it peer, people to people. P2P lending is an important aspect coming. This P2P lending will change the entire banking scenario. Remember this. So, financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on their investments. So, P2P lending will change the entire sphere. Right now, what is happening? Why are people depositing money in the banks? Because they don't know who is to pay, who wants the loan, and they don't have the confidence on that person who will get the loan. Right? Suppose if I get somebody, tomorrow you require the loan. Okay, you require, let's say, 1 lakh rupees, and I am having excess 1 lakh rupees. So why should I deposit it in the bank and then that bank gives you the loan? I'll directly give you. So that is known as P2P lending. So there are certain problems in that, but those can be tackled nowadays. There is account aggregator system that can definitely tackle it. So it means secured and unsecured personal loan, the person who wants it with the investor, connecting this buyer and seller. It's that simple. Cloud computing, it refers to the delivery of computing services including servers, storage, databases, networking, software, analytics, and intelligence over the internet to offer faster innovation, flexible resources, and economies of scale. Cloud computing, you must definitely know this definition because this is the important part of technology in international banking. Computing services including servers, blah blah blah, storages, databases, software, analytics over the internet. Now remember, over the internet means this is the server will not be a physical server, it will be in the cloud. You might have seen many of these, right? Many of the companies have come like that. What GoDaddy, right? There's a company called as GoDaddy. Check that, okay? That is giving online servers. Okay, there is many of them are there. One I know because I've used that data. Servers, storage, databases, networking, software, analytics, everything on the internet. There is no physical existence. To offer faster innovation, flexible resources, and economies of scale, right? Clear? So everything is on internet over here. There is no physical thing. Okay. Now, to join, as I told you, join this Adda 24/7 app, download this app, or join the YouTube channel. But how to join it? See, just scan this QR code right now. This blue QR code is for Telegram channel, official Telegram channel. Scan it. For all, you might be in JIB, you might be in CAIIB or any other bank promotion. Similarly, YouTube. Scan this right side QR code, this one, okay? This QR code. Then if you want to join this Instagram, okay, join this QR code, Instagram. Okay, scan this QR code and you'll join this Instagram channel. Remember, there are many fake channels available. Fake channels. So we need not join those. Okay? Because here in the world there are always copycats, right? So that's why join it immediately. DigiBank, an entire bank squeezed to fit in your smartphone. DigiBank, there is no physical existence of that bank. Remember, there is no physical existence of that bank. There is only one head office and there are no branches. DBS has started DBS. They have started DigiBank. Many of the Indian banks have also started DigiBank. No physical branch, only head office, and that's it. Regulatory sandbox. This is a new definition. It refers to an environment where it allows the regulator, the innovators, and the financial service providers and the customers as final users to conduct field tests to collect evidence on the benefits and risk of the new financial products. So, where regulator, innovator, and the financial service providers. Now look at this. All these elements, these are all the we call the stakeholders. Regulator, innovator, financial service provider, customers as the final user to conduct field test to collect evidence. So field test is collected. Important part over here is field test. Okay, conduct field test to collect evidence on the benefits and risks of the new financial product. So whenever I'm launching a new product, what are the benefits of that? Will it be harmful? Will it suffice my this purpose? So that all evidence is collected using this regulatory sandbox. Okay, understand this word is very important. Conduct field test to collect evidence on the benefits and risk of the new financial products. Robotic process automation. It refers to the process of assigning manual repetitive tasks to robotics instead of humans in order to streamline workflows in financial institutions. So it refers to what? The process of assigning manual repetitive tasks to the robotics. Here, assigning manual repetitive tasks to the robotics instead of human beings. So robotics instead of human being, that is the basic logic behind this robotics process automation. So human beings should not be used for repetitive jobs. Human beings should be used for innovative jobs. Okay. Blockchain technology. Blockchain is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. Okay, so blockchain is basically recording information. Recording information. Okay, yeah. So now, guys, the exams are near. Okay, so the exams being near, immediately join the revision batch for CAIIB. Look at this. Go to JIB and CAIIB. I will always suggest you to go through the app. In the app, you get 1% extra. Okay. Click on this CAIIB November 23. Look at this CAIIB November. Okay. Click on this. You'll see this combo power CAIIB Power Pack Revision Combo Batch. Join this immediately. Starting from 1st November. Immediately join it. Book your seats now because limited seats. See here, it's already written. Limited seats. Recorded video available. Interactive classes. Expert faculties. Test series. Ebooks. So many things you are getting. Click on these ebooks. You'll see subject wise ebooks. Click on this subject. You'll see chapter wise ebooks. Isn't it? In such details you are getting. And they're also at what fees? Look at the fees also. 80% off is going on. 299.80. My God, complete CAIIB in 299. Join it ASAP. Okay. There's also Mahapack. You can join the Mahapack also. In the Mahapack, you will be getting multiple batches. Okay. Look at this. Go to JIB CAIIB Mahapack. See this. Yeah, JIB CAIIB. Click on CAIIB Mahapack. Okay. CAIIB Mahapack. Click on this. You'll see again. Look at the fees. Now look at this. In Mahapack, you are getting double validity. It's a double Dhamaka offer. Double validity plus 80% off. Both the things. You get live plus recorded videos. Both of them. Expert faculties again, interactive classes, recorded videos, limited size batches, 6 plus 6 months. You buy for 6 months, you get it for 6 months free. You buy for 12 months, you get 12 months free. Okay, ebooks, videos, test series, everything is available. So join immediately. Okay, I'll be back tomorrow with another series. Till then, keep studying. We are in the BFM Sankalpa series and we are covering various important theory, numericals, objective questions in the same. Today we will be covering the objective questions. Before going ahead, have you seen yesterday's series? Means Saturday and Friday I had completed one series that was numericals. Very important numericals were done. Have you seen that? Type yes if you have not. Kindly follow it again. Go to the channel, follow it again. Important forex numericals were covered. Very important. Huh? So if you have not covered it, if you have not seen it, kindly go and see it because it's very important. You will get case studies. 2 case studies you will get on 5 marks and both the case studies I had covered it over there. Okay. So let's start with the numericals today. Okay. Okay. All done. Everyone set now. So let's start. Chalo. First question. The liquidity risk of the bank arises from. So liquidity risk of the bank, of any bank. Liquidity means what? What do you mean by liquidity risk? It means that I don't have money at right time. That is very important. At right time, whenever I have to pay my EMI, I don't have money. That is a liquidity risk. Same thing about the banks also. Bank has to pay some bond holder. Okay. At that time, bank doesn't have the money. That is liquidity risk. If some depositor comes for withdrawal, bank doesn't have money. That is a liquidity risk. So this liquidity risk of the bank arises from number one, funding of long-term assets by short-term liabilities. Long-term assets by short-term liabilities. What do you mean by this word? Suppose let's consider all these cases. Okay, let's consider all these cases. Let's say this is deposits. Here, liabilities means deposits, assets means loans. Okay. Now, case number A, funding of long-term assets by short-term liabilities means what? I'm having a deposit of 1 year and I'm giving a loan of 3 years. Will this create a liquidity risk for me? Just type yes or no over here. Huh? Let's see later. B1. Funding of short-term assets by long-term liabilities. So deposit of 3 years and loan of 1 year. Will it create a problem for me? Funding of long-term liabilities by short-term assets. C. Funding of long-term, this is ab initio wrong. This is from start only wrong. Why? Liabilities funded by assets. Is it possible? Not at all possible. Assets are always funded by long-term liabilities. Means long-term or short-term. Assets are funded by the liabilities. So C is ab initio right, wrong. Okay, ab initio means from the start itself. We need not even discuss this. That is the point. Now the question lies between A and B. Between A, 1 year deposit I am having and 3 years loan I have given. So will it create a problem for me? Yes, it will create. Why? Because this guy who has deposited, this person will come to me after 1 year, but this person will pay to me after 3 years. So this will be a problem to me. What about B? If this person has given me a deposit of 3 years, this guy will come after 3 years. Isn't it? This guy will come after 3 years, but this guy will pay me immediately after 1 year. So I won't have any liquidity problem over here because whenever this person comes, I can repay him back, him or her. Okay. So the answer is A. Funding of long-term assets by short-term liabilities. This is a basic logic behind which, based on which this question is dependent. And such questions are asked to in exam. Remember. Okay. Move on. Funding liquidity risk is defined as funding liquidity. Remember this. Funding means I don't have funds. Liquidity risk, but related to funds. So that is defined as excess of liabilities over assets. Excess of long-term liabilities over long-term assets. Excess of short-term liabilities over short-term assets. Inability to obtain funds to meet the cash flow obligations. Very simple definition. Excess of long-term liabilities over long-term assets. Is this a liquidity risk? Excess of liabilities means more of deposits, less of loans. Obviously, that can be the answer. Similarly, B can also be the answer. Look at this. All the answers seem to be right. All of them. You check this. All of them seem to be right. Liability is greater than assets here. I'll show you over here. Liabilities greater than asset. In all the cases, logic is same. Okay. Liabilities are greater than assets here. Over here, excess liabilities over assets. Here, long term over long term. But after all, the same. Liabilities and assets. Short term over short term. Logic is same. Liabilities over assets. So, logic is liabilities are more than assets. So, definitely that is the answer. Whenever I have deposits of, let's say, 100 rupees. Okay. And loans of, let's say, 70 rupees. Okay. So, will it be a problem for me? As a bank, do I have a problem in this case? Okay, just check your bank's ratios, your bank's loans and asset deposit ratios. Is it always 100? Let's say this is 100, this is also 100. Is it always 100? No. RBI has given the term as your liabilities and assets should always be 70%. So this is right. Okay, assets will always be lesser than your liabilities. Always. Means basically loans will always be lesser than your deposits. Of course, the ratio is matched so that the rate of interest NII is not affected much. So the correct answer is this. Inability to obtain funds to meet the cash flow obligation. That is the correct answer. Okay. So funding liquidity risk is defined as inability to obtain funds to meet the cash flow obligations. Okay. Liquidity risk in banks manifests in different dimensions. Which are these? What do you mean by this? Manifest means comes. It comes in various ways. Okay. It comes in various ways. Dimensions means ways. Let's keep words simple, isn't it? So liquidity risk in bank comes in different ways. What are these? Funding risk arises from the need to replace net outflow withdrawal and non-renewal of deposits. It can be. Just answer. Think over it and answer. Fine. So here, CAIIB is not like JIB. Just you got the answer, tick it. No. Here you have to think. Funding risk arises from the need to replace net outflows. Non-renewal of deposits means whatever is going out, that needs to be replaced. Suppose if tomorrow there is a huge withdrawal from your bank, run on the bank we call it, run on the bank, right? Anyone knows run on the bank? What is run on the bank? Type in the comment section. Okay, just type, do you know run on the bank concept? Type yes or no. Only that much type it. Yes or no. Yes or no. Only that much. Don't give me run on the bank definition. It's a big definition. Yeah. Yes, yes, yes. No, no, no. Yeah. Some no's I am seeing. See here. Run on the bank means when all the customers of your bank, remember whatever I am saying, when all the customers of the bank come for withdrawal of deposits, all of them. So that is known as run on the bank. There's some negative news in the newspaper, something wrong about your bank. So everyone comes for withdrawal. That is run on the bank. So coming back to the question, withdrawal, outflows, withdrawal. So we need to replace these withdrawals through fresh funds. So liquidity risk may arise from this also. Number 2, time risk arises from the need to compensate for non-receipt of funds, NPAs. Means basically, suppose if I've given a loan, so what is my logic? The logic says that that person will pay me the EMI, and or CC if given that person will pay me the interest, and that interest I'll use it for paying to the depositors. But if I don't get that interest, don't get that EMI, then what? So that will also create a time risk. Time risk means what? At the time, I'm not having the funds. Call risk arises due to crystallization of contingent liabilities. So call risk arises from crystallization of contingent liabilities. Contingent means what? Contingent means which was not to come, or future transactions, future, like bank guarantee, LC. Okay, these are all contingent. So it comes in which of these cases? Both A and B. Okay, I'll mark it like this: A, B, and C. That is the best answer. So the answer is actually this: A, B, and C. Because funding risk is to replace the net outflows. That is also correct. Time risk is for compensating the non-receipt of fund. That is also correct. And call risk is also a type of this liquidity risk only. Because if tomorrow there is a huge bank guarantee to be paid by you, then from where will you get the funds? Urgent funds. Okay. So both, both, actually it's A, B, and C. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting latest updates from IIBF on JIB and CIB. Means what is updates from IIBF? IIBF gives various notifications. Like now it's exam time. So it will give certain notifications that this exam time changed, that exam time changed, this subject's portion is this, something has been added over here, something like this they'll give. So these notifications are explained on this channel immediately. Officers Adda 24/7. Also you get free YouTube series. Here right now what are you watching? You're watching the same free YouTube series. So you get a free YouTube series on the channel for all the subjects of JIB and CIB. All. Okay. So that's why subscribe to it, click on the bell icon, click on the like button, share it with your friends. Okay. When an asset maturing in where an asset is maturing in 2 years, the liability risk will be, suppose if any asset means loan is maturing in 2 years. Okay, 2 years means what? I have given a loan and that guy or girl will be paying me after 2 years. Okay, so what is the liability risk? Now look at this liability risk. Means what risk will I face from the depositor's angle? Basis risk, yield curve risk, gap risk, embedded option risk. From the depositor side, I'll face this risk, depositors, embedded option, right? See here, if this asset is maturing in 2 years, means there is a loan. Let's look at it this way, loan. Okay, if this loan is maturing in 2 years, this deposit, I may face a deposit. Here, I have to fund this loan by this 2 years. So what I have to fund is, I have to see to it that I have sufficient deposits for this loan. But if these deposits get matured, FD gets matured, there is a withdrawal, then will I get the same FD of the same amount afterwards? If after the withdrawal, will I get the FD of the same amount at the same rate? That is known as embedded option risk. Embedded means what? Anytime it can withdraw. Suppose if I need this 1 lakh rupees over here and this 1 lakh is withdrawn from here, depositor's angle, then my balance sheet is in a problem. So embedded option risk means there is a chance of withdrawal of FDs, withdrawal of savings deposits, plus there is a chance of repayment of these loans also. Now this is from the loan side. Somebody repays these loans. So embedded option risk is for both the sides, loan also and deposit also. Here we are talking of liability, deposit side. So that's why it's the main embedded option risk. The risk of adverse variance of mark to market of change in the market price of the interest rate instruments, equities, is called. So mark to market. What is mark to market? Mark to market means that basically the logic behind mark to market is, suppose if I brought let's say a bond, and that bond I am not going to sell immediately. But mark to market means what? Whether if what is notionally I am gaining some profit or not in that. That's the meaning of mark to market. Suppose if let's say you have brought a flat, you have purchased a flat, okay, for staying flat you have purchased. Now this flat you won't be selling it now because you are staying in that. But you get the daily rates for this. There are certain brokers who come to you, sir, the flat right now you had brought it at let's say 30 lakhs. Now the flat is giving you around 50 lakhs. So this is what this difference is known as notional or mark to market. Notional or other name is mark to market, M to M. Okay, M to M means what is the rate at which I had brought and what is the present value of my security. Okay. So risk of adverse variance of mark to market value of change in market price in the interest rate instruments. Interest rate instruments is called as price risk, market risk, translation risk, both A and B. What is the answer? Let me get it from you now. I'll explain you, not an issue. But let me get it from you first. It is both A and B. Price risk and market risk, both. Because here market price risk is actually a part of market risk. And price risk arises because of the interest rates. If the interest rates go up, interest rate goes up, then the price of the bond will go down. Price will always go down. Price. Okay. So this is basically the logic behind this. Which of the following is not a market risk? Not. Okay, not a market risk. Compliance, transaction, legal, all of the above. Let me think. Type fast in the comment section. Which of the following is not a market risk? Not. Market risk means what? What is a market risk? Market risk means that risk which is not in your hands. Not in your hands. Okay, keep it very simple language. Okay, not in your hands. Russia-Ukraine war, not in your hands. Then the COVID situation, not in your hands. Right? RBI changing the repo rates, not in your hands. So this is all market risk. So which of the following is not a market risk? So compliance risk. Compliance means what? Submitting the returns or submitting the consent documents to RBI. It's in your hands. You have to follow the compliance. So it is not in your hand, right? Not a market risk. So it is, I'll write it not a market risk. N. Transaction risk. Transaction means whatever transaction I'm doing, I must maintain precautions in that. So there's no market risk. External forces are not acting on this. Legal, again, it's a part of this transaction risk only, right? Means basically operations risk. These are all operations related risks. So this is not a market risk. Answer is all of the above. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we require for clearing JIB and CAIIB, we get it over here. So that's why download it right now, immediately, and start studying. Don't just download it and keep it. You have many apps in your mobile. Okay, just tell me, everyone, how many total number of apps you have in your mobile? How many? We don't even know the numbers. Even I don't know. How many of these apps have you watched? Do you watch regularly? I know you watch only WhatsApp regularly. Only WhatsApp. Tick, 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 tick. And some other one or two more. Nothing else. Okay. Somebody might be watching that shopping apps, Amazon and all those things. That's okay. But remaining apps, we just download it and keep it. Don't just download it, use it. Go through it. What are you getting? You're getting many free features over here. Of course, paid classes are there, but free features also, free tests you are getting, free books you are getting, free classes you are getting. So download it and start studying, okay? Country risk is an example of market, credit, operations and liquidity risk. So country risk is an example of what? It is a part of credit risk. See here, credit risk always is of two types. Always remember this, two types, okay? One is country and second is counterparty. I'll just write it, okay, full only I'll write it, counterparty. Because many of the students might not understand this. Short form of this is actually CP, okay, but counterparty risk. So country risk and counterparty risk. Credit risk always has two parts, okay. All of the following are types of price risk except, now again we want except means not, which is not the type of price risk. So all of the following are the types of price risk except commodity price, exchange rate, stock price, counterparty risk. Just now I gave you. What is the answer? Just now, yeah. Type fast. Just now I gave you, yeah. This one, look at this. Credit risk is has two parts, credit and counterparty, country and counterparty. So counterparty will be a part of what? Will it be a part of price risk? No, it is a part of credit risk. So this is credit risk. This is not the one. This is yes, this is yes, this is yes. All these are price risks. But this is a part of credit risk. Okay. In financial market, bond prices and yields are JIB studies. Okay. Bond prices and yields are inversely related, directly related, inversely or directly depending on the type of the bond, and none of these. JIB. Okay. Give me the answer. Yes, it is. What? What is the answer? Bond prices and yields. Inversely, right? If the yields go up, what is yield? Yield means asking rate. If the asking rate of any bond goes up, the price of that bond will go down. Everyone, just now I told you that join our Officers Adda 24/7 YouTube channel. But how to join it? Sure, we are having 3 important channels. One is on Telegram, second is on YouTube, and third one is on Instagram also. Scan this QR code for this blue one for this Telegram, this black one for this YouTube, and this one for this Instagram. Immediately pause the video, scan this. Now, why should you join here? We gave whatever is available. What is available on these channels? Free tests, free ebooks, free classes. Okay. Then paid classes are also available on the app. So scan it and join. Whatever is free, grab it fast. Okay. So now, friends, before going, one important thing never to be missed out. Join our revision batch going on. Join fast. Okay. Click on JIB and CAIIB. Click on CAIIB November 23. Now I'll show you the details. What all do you have in this? English batch. CAIIB Power Pack Revision Combo Batch. Okay. Click on this. You will see all the 4 subjects. ABM, BFM, ABFM, BRPL. All of them covered. Numericals, objective questions, case studies, everything covered. Test series, ebooks, videos. Click on these ebooks. Look at this. You are getting ebooks also. Click on these ebooks. You will see this chapter-wise, subject-wise ebooks. Click on any of these subjects. You will see chapter-wise ebooks. Similarly, test. Click on this test series. You will see prime pack test series. Click on this. You will see various mocks, right? So click on this. You will get the mocks. Means pay this and you will get unlocked over here. So that's why. Join this test. Join this Power Pack Revision Combo Batch immediately. Okay, you can join the Mahapack also, and importantly, 80% off is going on. Joy 80 code. Click on this buy now. Then you will see the fees. See this 80% off. 14,999 reduces to 2,999.80. Click on continue. Fill in the details: full name, phone number, mobile number, email, and that's it. Make the payment. That's it. Okay. Then similarly, you can join the Mahapack also. In Mahapack, you get multiple batches. Let me show you. So this. Go to again the front page. Say this CAIIB Mahapack. Click on this Mahapack. Now you will see double validity going on the Mahapack. Double validity means you buy it for 6 months, you get it for 12 months. You buy it for 12 months, you get it for 24 months. And same thing, test series, ebooks, videos, click on them, you will see chapter wise. Expert faculties, interactive classes, recorded videos, limited size batch, 80% off and double validity. Both the offers are going on. So join them immediately. Okay, I'll be back tomorrow with another series. Till then, keep studying and do join the. Welcome to Adda 24/7. We are in the Sankalpa series for BFM. In this, we are covering various numericals, objective questions, case studies, okay, and theory questions as well. So follow this series completely. It is available in the playlist in the Officers Adda 24/7 YouTube channel. Subscribe to this channel. So let's move on immediately. Okay, today I'll be covering different yield curves, types of yield curves. Okay, and then the questions on that. Very important part from your exam perspective. Yield curve. There are 4 types of yield curves. Always remember. Yield curves. One is this normal yield curve. Normal. Normal means what? Let me explain you this. Suppose if you keep a FD. Let's think of FD only. FD. You keep a FD of 3 months. 3 months. Okay. And then I keep an FD. Let's say me. I keep an FD for let's say 8 years. Okay, 8 years. FD is what is maximum FD available? Up to 10 years. Okay, in banking. So you keep the FD for 3 months and I keep the FD for 8 years. So if you are getting the FD rate of interest of let's say 3.5%. Okay, you are getting an FD rate of 3.5%. What do you think I should get this rate of interest? Should it be more than 3.5? I'll write it more than 3.5 or equal to 3.5 or less than 3.5. Less than 3.5. Okay. So what should I get? What do you think? More than, equal to or less than. I'm keeping it for 8 years and here I'm keeping for 3. You are keeping for 3 months. So I'll be getting it for more than 3.5. Correct. I'll be getting more. Why? Because I'm keeping the money for the higher period, okay, larger period, right? So this depends on what? Keynes theory. Remember, Keynes theory is there. It says that the more you part with your money, the more are the returns expected. Now look at this curve. This is the maturity period and this is the yield. So this is 3 months over here and this is 10 years over here or 8 years over here. So that's why if you look at it, the rate of interest over here is higher. The rate of interest over here is lower. Now apply the same logic to bonds. Bonds with the lower maturity will have lower interest. Bonds with the higher maturity will have higher interest. This is a normal yield curve. Now this is possible when here we assume something. What do we assume? We assume that the country will grow upwards. Getting this point? If my country is growing upwards, only then this is possible. If my country is going into recession, then it will be exactly reverse. The FD rate, the bond rate for 3 months will be higher and bond rate for 10 years will be lower. This is known as inverted yield curve. Inverted yield curve is a sign of recession and normal yield curve is a sign of good growth. India is presently over here. Many of the Western countries, including USA and UK, they are in this phase right now. They are going towards this. Okay, they are artificially keeping the economy running over here. Artificially right now. We won't go into those details because it's a huge topic. Remember, just if anybody wants to check, just check the yield curves for USA and UK in last year from June 22 to December 22, and then you'll understand everything. Right now they are in this phase, going in this phase, recession phase. That's why their yield curves are slightly inverted. They have kept it going right now. They have kept it around this flat or to the other extend to this upper level, but they can hardly sustain for some time. 1 year, 2 year, 3 year, that's it. Okay, now what is this flat yield curve? Flat yield curve means country is not growing at all, not going down, not going up. Flat. 3 months rate of interest will be same as that of the 10 years rate of interest. Humped yield curve. This is called as humped. Humped means what? There is slight growth in the initial period, but later again recession. So this is known as transition. Okay, transition means what? It grows in the initial years and then it transits to the lower growth phase. So recession phase. Here it is recession, here it is growth. So these are the 4 yield curves. In exam, mostly they will be asking you 1, 2, 3. Because this is transition, recession. Generally, this recession is asked more. Because why? This is only the typical one which is followed throughout the world. Okay. Now let's move on to the questions. When the upward sloping yield curve will appear, means when an upward sloping yield curve will appear, means upward means just now we saw this one. When will this appear? During the times of expansion, when the recession occurs, during economic transition, when long-term interest rates are lower than the short-term interest rates. Long-term are lower than short-term. So when will this occur? In the comment section. I want it in the comment section. A, B, C or D. It is during the times of expansion. A. Okay. Now tell me in B, C and D. Okay, B, C and D. There are 2 options. Now look at this question. There are 2 options which are same. In B, C and D, there are 2 options which are same. Now, which are those options which are same? B is what? Recession occurs. B means recession. C means economic transition. So this will be what? Humped curve, camel humped, right? This is this camel humped curve. It will be like this. Okay, this just now we saw this. What is D? Long-term interest rates are lower than the short-term interest rates. Means what? See this. Long-term is lower, short-term is higher. So it will be like this. Now if this is like this, then what is the recession? Recession is also the same. That's why B equals to D over here. Okay. It just I got it. The thought got into my mind. That's why I asked you. Okay. So upward sloping yield curve in the expansion, and recession means long-term interest rates are lower than the short-term interest rates. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we require for clearing JIB and CAIIB, we get it over here. Okay. Define the flat yield curve. Flat means, just now we saw that short-term bond rates are equal to long-term interest rates. Okay. So basically short-term rates equal to long-term. I think that is the answer or no. Let's see. Short-term interest rates are greater than the long-term. Short-term greater than long-term. So can you plot these curves? Okay, let me plot these curves. See this, short term equals to long term. So this is flat over here. B1, let's plot this B. Okay, short term are greater than. So short term greater, long term lesser. So it will be like this. Recession. Long term interest rates are greater than short term interest rates. So this C will be long term greater than short term. So it will be like this. Normal. Small companies provide greater yields than large company stocks. This has no base at all. There is nothing called a small company providing higher yields or higher returns. What is the yield? Yield means asking rate. Asking. Always remember. Demand. Rate in demand is yield curve. So it's nothing like this. Okay. So the answer is A. Okay. How do you define economic transition? Transition means that camel humped curve. Okay, transition in an economy from recession to expansion. Okay, transition in the economy from expansion to recession. None of the above 2 answers are correct and both are correct. So what is this? Recession to expansion. See here, A. Let's plot this curve of A. Recession to expansion. Recession means it will be first like this. Recession means inverted curve, right? To expansion. So it will be like this. So what is this? Again, it is a hump. Look at this. It is hump somewhere. Okay. So this is also true. From expansion to transition B1. Let's plot this B. So expansion to recession. So this is also true. So both are transition curves only. So both the answers are correct. Okay. Now how to join this Officers Adda 24/7 YouTube channel? Well, for joining this channel, scan the QR codes. This blue is for Telegram. Black is for your YouTube. Click on scan this. Okay. Then this one is for the Instagram. And how to join the Instagram, this YouTube using these codes. And there is a separate channel on WhatsApp. So you can join this WhatsApp channel also. Just type Officers Adda 24/7 on WhatsApp. You'll get it. Okay. On WhatsApp channels now. There is a separate option of channels. Okay. A yield curve that shows down-sloped curve is what type of curve? Down-sloped. Now this is easy. Normal yield curve, flat yield curve, inverted. All yield curves show down-sloped curve. Is this all yield curves show down-sloped curve? What do you think? The answer is normal, flat, inverted, down-slope, down. It will be inverted. Okay, inverted yield curve will show down-sloped curve. A yield curve that shows upward direction and which long maturity bonds have higher yields is known as. So if any yield curve is showing upward direction and long-term bonds are having higher yield, just now we saw it, isn't it? What is the answer? A, B, C or D? Type it in the comment section. Correct? Normal. Okay. Which of the following statements is false? A forward exchange rate is a good predictor of the future spot market. What is this? Forward exchange rate is a good predictor of the future spot market. Future. So forward rate is can predict the future spot exchange rate. Predict. Okay. A forward exchange rate and a future spot market may not be the same. So forward exchange rate and future spot market may not be the same. Okay. A forward exchange rate is an unbiased predictor of the future exchange rate. So forward exchange rate is an unbiased predictor of the future exchange rate. Okay. The spot exchange rate is a good predictor of the future exchange rate. The spot is a good predictor of the future. So we want what is false. What do you think is a false answer? Firstly, you should know what is true answer. Remember, nothing is over here in this question. It's just forward and future. Forward exchange rate is booked today for 2 months later. Okay. And future spot rate is the actual rate 2 months later. So that is basically the future spot rates. Here, just I'll explain you in simple terms. Today is what? Let's say any date. Okay. Let's consider 1st January. Okay. Jan 1, let's say. Today Jan 1. Okay. Now I book a rate today for dollar. And I book it for, let's say, March 1. I book the rate for March 1. Okay. So now understand what is forward exchange rate and what is future spot exchange. When I say forward exchange rate, I book this rate today for March. So this is known as forward because I have booked it today. Okay. Forward exchange. So this is forward exchange. Now what is future spot exchange? It means that actual rate on March, actual here, if I book this rate today for March, let's say at 80 rupees 75 paise. Okay, if I booked it at 80.75, but actually on this date it goes to, let's say, 83 rupees. So this is known as my actual future spot exchange, and this rate which I book it today for the future is known as forward exchange. Now remaining things you can definitely get it. Okay. Future spot, same thing. Forward exchange, same thing. So which is the false one? Where is the answer? I didn't get the answer. Let's call this A, B, C, D. A, B, C and D. What is the answer? We want false answer. It is D. D is false answer. Spot cannot predict future. Only forward exchange rate can predict future. Okay. The objectives of central bank include. What is the central bank? Central bank means not Central Bank of India. It is RBI. We are having a separate bank called as CBI, Central Bank of India. Okay. So the objectives of RBI include to ensure country's balance of payments remains in equilibrium, to accumulate the country's foreign exchange reserves, to ensure the implementation of country's exchange rate policies, to control international trade. What should be the answer? RBI's main role is what? Ensure country's balance of payment is in equilibrium. Accumulate foreign exchange reserves. Accumulate means go on accumulating the dollars to ensure implementation of country's exchange rate policy. Okay, implementation of country's exchange rate policy, and to control international trade. See here, nobody can control international trade. That's out. Accumulate is out. Now the question is only between A and C. Ensure country's balance of payments is in equilibrium, or ensure that implementation of country's exchange rate policy. See, this implementation depends on individual banks. Whatever policy is there, that is done by individual banks. Okay, that is not done by RBI. RBI gives the policies. So the answer is A. To ensure that country's balance of payment remains in equilibrium. Subscribe to Officers Adda 24/7 YouTube channel. Just now I told you how to subscribe to it. You can subscribe it on the YouTube also. You can scan the QR codes, okay, and do it. Because you will be getting various free YouTube series. All these. Right now you are watching the free YouTube series. You get it over here, okay. The exporter should necessarily submit the export documents to the bank within 15 days from the date of documents, 15 days from the date of shipment, 21 days from the date of documents, 21 days from the date of shipment. Now what is the answer? Let me see how many of you can answer this. Yeah. 15 days from the date of documents, 15 days from the date of shipment. Okay, from the date of, what do you mean by shipment date? Shipment. What is the shipment date? Shipment date means whenever you get that bill of lading, on that there is a stamp called as shipped on board. Shipped on board. On board. Okay. This shipped on board stamp, whenever, whatever date it has, that is known as the date of shipment. So this exporter has to submit the documents to the bank. It's not, actual word is not bank. It is called as AD, authorized dealer. Okay. So the exporter has to submit the documents to the AD within 21 days from the date of shipment. Remember, 21, and these days are calendar days. Remember, 21 calendar days. There are 2 days in banking. One is calendar, second is banking days. Banking, whenever banks are open. Okay. The multinational company encounters the following exposures to foreign risk. So any MNC will encounter which type of risk? Translation, economic, transaction, and all of the above. What is each risk? What is translation risk? Translation risk means what? Suppose if I am, let's say, SBI. Okay. Is SBI a multinational company? Type yes in the comment section. Is SBI a multinational company? It is fine, because multinational means which has the branches or offices in more than one country. So SBI has various branches in outside also. Okay. So let's say SBI is having a USA branch, and this USA branch is having some profit. Let's say $1 lakh. It has a profit. Okay. $1 lakh. Now this $1 lakh has to be brought to India, not physically. Whenever on 31st March, SBI has to report its balance sheet to RBI. So while reporting it, it will also report the balances or the profits of its subsidiaries which are in foreign. But those will be reported in rupees, because RBI follows rupee system. So this dollar will be converted to rupees notionally. That is known as translation exposure. Whenever I convert this notionally, whatever notional profit I have or loss I have is known as the translation exposure. Economic exposure means basically economics related to financial. Transaction exposure means related to transaction, settlement. Mainly this will be settlement exposure. Okay. So any MNC will see what type of exposures, all of these, isn't it? The role of hedging agent is, means what is hedging actually? What do you mean by hedging? Anyone? Type in the comment section, what is hedging? Hedging means, yeah. Hedge. Buy in one market and sell in another. Suppose let's say there is a Reliance share, Reliance, okay, and in NSC, let's say it's running at 2500, and in BSC, it is running at 2503. Now this change happens only for 3 to 4 seconds, 4 seconds only, not more than that. So within these 4 seconds, the whole game is played. So I'll buy 1 lakh shares over here and sell 1 lakh shares over here. Sell. Here I buy. What does this mean? I'll do it in 4 seconds. Buy here, sell here. So I earned 3 lakhs over here in 4 seconds. But what is the risk? If I delay in this, I'm gone, because this will automatically catch up with each other. So what is the role of hedging? Forget the agent. What is the role of hedging? Assist the firm in determining which foreign exchange transactions should be hedged. So here, depends on which currency or which commodity you are hedging. There should be enough liquidity in that. Liquidity. If there is no liquidity, then there is no logic of hedging. Hedging is always done in liquid stocks, liquid commodities. So which is to be hedged? So that should be decided. That should be supported by the team. Whichever agent's team is there, it should support that. A. Assist the firm in determining the types of currencies or interest rate swaps. So how should I hedge it? See here, what is to be hedged? First question is what? What is to be hedged? And second is how. So any hedging agent's job is answering these two questions, what and how. Okay. So answer is what? Over here. Answer is C, both A and B, isn't it? So friends, before going, the new Power Pack revision combo batch will be starting, okay, on November 1st. So join it fast. Okay. All the 4 subjects are covered. ABM, BFM, ABFM, BRBL, numericals, objective questions, everything. Revision batch. Okay. Fast batch. So join it fast. Also you can join the Mahapack. In the Mahapack, you'll be getting the multiple batches, plus ebooks, plus tests, everything. How to join the Mahapack? Let me show you. See here, go to Adda 24/7. In fact, I would suggest you to go through the app. Okay, in the app you are getting the coin systems. Coin systems means that will give you around 1% extra. Okay, go to Adda 24/7. Look at this. Okay, come, click on JIB and CAIIB. On the front page itself, click on CAIIB November 23. See here, now we are in November right now, November exam. So click on this. You'll see this Power Pack revision combo batch. Click on this combo batch, English one. Then you'll see the details. See, what are the fees? 77% off, 2644. Huge discount is going on. And what all do you get? You get test series, ebooks, online live classes. Click on these ebooks. See, all the subject-wise ebooks are available. Click on this subject. You're getting chapter-wise ebooks for each subject. Okay. Similarly, you can go for the same and check for this test series also. Subject-wise. Okay. Click on this. And then you get again mock 1, mock 2, module-wise. Okay. So that's why join it fast. And what is the fees? This fees is what? Hardly 2644.77. Yeah, discounted offer. So join fast. OCT 77. Apply this code. Click on buy now. Okay. See, this code is already applied over here. Else, if not applied, you can apply it. Click on apply and then go on. Okay. Click on continue. Fill in the details. That's it. Similarly, you can join the Mahapack as well. In Mahapack, as I told you, you get multiple batches. Look at this. CAIIB Mahapack. You get multiple batches. Similarly, e-video, ebooks, videos, test series, online classes. Mahapack you are having for various maturities. 3 tenures, 3 months. The fees is very less, 57449. 9 months, 8472. 12 months, 11861. And all of them are having 77% off. So join it as well. Okay. I'll be back tomorrow with another series. Till then, keep studying and do join the batches as well. Okay. So now guys, the exams are near. Okay. So the exams being near, immediately join the revision batch for CAIIB. Look at this. Go to JIB and CAIIB. I will always suggest you to go through the app. In the app, you get 1% extra. Okay. Click on this CAIIB November 23. Look at this CAIIB November. Okay. Click on this. You'll see this combo CAIIB Power Pack Revision Combo Patch. Join this immediately, starting from 1st November. Immediately join it. Book your seats now because limited seats. See here, it's already written limited seats. Recorded video available, interactive classes, expert faculties, test series, ebooks. So many things you are getting. Click on this ebooks. You'll see subject wise ebooks. Click on this subject. You'll see chapter wise ebooks. Isn't it? In such details you are getting. And they're also at what fees? Look at the fees also. 80% off is going on. 299.80. My God, complete CAIIB in 299. Join it ASAP. Okay. There's also Mahapack. You can join the Mahapack also. In the Mahapack, you will be getting multiple batches. Okay. Look at this. Go to CAIIB Mahapack. See this. CAIIB CAIIB. Click on CAIIB Mahapack. Okay. CAIIB Mahapack. Click on this. You'll see again. Look at the fees. Now look at this. In Mahapack, you are getting double validity. It's a double dhamaka offer. Double validity plus 80% off. Both the things. You get live plus recorded videos. Both of them. Expert faculties again. Interactive classes, recorded videos, limited size batches. 6 plus 6 months. You buy for 6 months, you get it for 6 months free. You buy for 12 months, you get 12 months free. Okay. Ebooks, videos, test series, everything is available. So join immediately. Okay. I'll be back tomorrow with another series. Till then, keep studying and do join the batches. Revision batch starting from November 1st immediately. Hi friends, welcome to Adda 24/7. We are in the Sankalpa series for BFM. In this, we are covering MCQs plus numericals plus case studies plus theory questions. Okay, so follow this series completely. Today we'll be covering module C questions. Module C. C and D. C in fact, mainly C. Here we'll be covering the liquidity part. Liquidity risk is an important risk in your BFM. Okay. So we'll be covering this treasury management, module C and liquidity part. Okay. So let's start. We'll be covering the objective questions only today. No numericals, no theory, anything. Only objective questions. Which of the following exchange operations have been useful in treasury management operations? So, which of the following foreign exchange operations have been useful? Okay, for treasury, useful in treasury management. So, treasury management is arbitrage and swaps. Now, you can definitely answer this here. Looking at this at the CAIIB level, you can definitely answer me. Yes, sir. Yes, sir. Yes, sir. Answer will be what? Let me see what is the comment section. In the comment, what are the answers? I know all of the answers will be what? C, right? All of the answers are C. I know. But the problem is, do we understand arbitrage and swaps? We have just heard the names. Do we understand this? How many of you understand this arbitrage? How many of you understand this swaps? Type yes in the comment section. And if you don't, kindly type no. Not an issue. I'll explain you both. Okay, arbitrage also and swap also in simple language. Okay, what is arbitrage? Arbitrage is basically buying in one market. I'll write it simple. See this: buy in one market and sell in another. Immediately, sell in another. Immediately. Very important term is immediately. Okay, immediately. This is an important term. Immediately, because everyone does the same thing, buy somewhere and sell somewhere. That's business. But immediately is an important part. Means I'll explain you one simple example. Suppose if I'm having, let's say in India, how many stock markets are there? How many markets are there in India? There are two markets, right? NSE and second is BSE, right? BSE. Okay. Many a times what happens, there is a difference in prices. For example, let me show you Infosys. Let's say Infosys. Okay, Infosys. If Infosys price on NSE is, let's say I'm taking example, let's say it is 1000, and on BSE at the same time it is, let's say 1003. Now this difference on NSE and BSE remains for hardly, I'll tell you, 4 seconds. 4 seconds, hardly, not even 4 seconds nowadays. with the technology, it is hardly 3 seconds max to max nowadays. It immediately gets converted or collapsed. Okay, it matches with each other. Now, if I am the arbitrage person, what will I do? Do you know? I'll buy, let's say, 1 lakh shares, 1 lakh shares, okay, of Infosys here at the same time, right now. And I'll sell 1 lakh shares at BSC right now. Here I'll sell, and there I'll buy. What happens? At the same, in hardly 4 seconds, I'll do all these jobs. My computers, my internet needs to be very fast in this. Okay. So what have I done? I've earned 3 lakh rupees. 3 lakh. See this, 1003. 3 into 1 lakh. This much I've earned in how many? 4 seconds. That is arbitrage. Buying in one market and selling in another market immediately. That's why arbitrage is the most important and the safest transaction. Safest. But it is safest subject to the timelines. If you are able to follow the timelines, then it's safe. If you are not able to follow the timelines, you are gone. Okay. So that is arbitrage. Now what is swapping then? Swapping, remember, only you remember one basic about swapping. Swapping means always there are two legs in swaps. Always there are two legs. Okay. One is fixed and other is floating. Okay. Floating. What do you mean by this? Keep it very simple. Suppose I'll give you this example over here. Okay. So suppose if I take 1 lakh rupees from you, 1 lakh. Okay. And guarantee you 7% rate of interest. 7%. Here I am taking it from you. So I have to give you 7%. I have to give 7%. And what do I do with this 1 lakh rupees? I invest this 1 lakh rupees in the stock market. Stock. Now in this stock market, this 1 lakh rupees I may get at the year end. Here 7% is for the year. So at the year end, I may get 25% returns also, because after all it's stock market, it can give you heavy returns. Or I may get 0% returns also, or I may get minus 25% returns also, negative also. Stocks might go down also. So this is what? This is floating and this is fixed. So swap always has two legs. One is fixed, another is floating. Now this swap can be of various types. It can be currency swap, it can be interest rate swap, it can be any swap, commodity swap, anything. But logic remains the same, fixed and floating. Okay. And one more important term about swap is it's an exchange of series of payments. Series means, example I'll give you, RD. What is RD? Recurring deposit. It is a series of payment. I'll give you 1,000 per month, and at the end of the year, you as a bank will give me whatever 12,000 plus that interest. Right? So it is an exchange of series of payment. Everyone got this? Swap and arbitrage. Very important terms. These are the derivative instruments. There are almost 7 derivative instruments, 7 to 8. That's why I'm saying join the classes, paid classes, because everything is I won't be able to cover it over here. Okay. There are many others, FRA, forward, future. Okay. So we'll cover it in the classes. Okay. So now the answer is A and B both. You got it, everyone? Type yes in the comment section if you have understood it. Everyone. Type yes if you have understood it. Okay, move on. Chalo, next one. Risk in the trading securities may arise from the following activities. So risk in trading securities. Securities means what? It can be anything. It can be shares, it can be bonds, it can be anything. Forex, then equity holding, lending and repos, and all of these. So securities may arise, risk in this trading may arise because of what? It can be due to Forex also. It can be due to equity also. It can be due to repos also. The repo rate also keeps on changing. Right? So the answer is, what is the answer? Correct answer over here? Comment section. Answer is A, B, C or D? D. Correct? Risk in trading securities may arise from the following activities: exchange, equity, repos, all of these. Which of the following is not an agency service of the bank? Agency service. Okay, now this is a simple question. Extending credit, escrow, merchant banking service, and insurance selling. It should not be an agency service. You want not. Okay. Agency means what? In this product, the bank will get a commission without any risk. Look at this. Agency, the main point about agent is agent. Any agent. We see that LIC agents, we see this mutual fund agents. What is the rule? They have twofold rules. One is commission. They get the commission. Okay. And second is no risk. They don't have any risk. Agent's role is only agent. Agent just plays as a middleman between that company and you. So if tomorrow something happens, the agent will directly point out to that company. Go there and solve the issues. So no risk. So that's why when your bank acts as an agent, it also gets 2 points over here. Commission and no risk. So in which of them it is not the agency commission, means which is agency service, or which is the core banking service. Core banking service is this, extending credit. It is not the agency service. Escrow is an agency service. Escrow means what? It's a temporary account. Temporary account. It is opened generally when there is a project to be done between two companies. Okay, so that is an escrow account. Merchant banking services. So this is also agency service. Your bank gets a commission. Where do you get merchant banking services? We generally give this in IPO. It doesn't come to you at a retail level. It goes at a corporate level. Insurance selling. This comes to you. You also do the same thing, right? So not an agency service is extending credit. Everyone download Adda 24/7 app on your mobile. In this app, you'll be getting the premium study material, plus live classes, ebooks, tests, whatever we require for clearing JIB and CAIIB, you'll be getting it over here. Okay, so that's why download it right now. Okay. What is the off-balance sheet risk? Look at this, off-balance sheet risk. It is contingent in nature. It can occur on account of issue of guarantees, committed credit lines, and issue of LCs. Bank's commitment may happen on account of failure to meet the payment obligations, and all of these. So now let me get the answer from you first. What is off-balance sheet risk? Is this A or B or C or D? All of them. Yeah. Answer is, everyone, the answer is D, all of these. Okay, all of the above. Remember, off balance sheet means what? Which is not shown in the balance sheet. What is not shown in the balance sheet? Contingent liabilities are not shown in the balance sheet. Contingent. Okay. Now, what do contingent liabilities include? Contingent liabilities include bank guarantee, BG, LC, court cases. Court cases are also contingent liabilities. Okay, court cases. So these are the three main contingent liabilities. So off balance sheet risk means contingent in nature, can occur on issue of guarantees, and bank's commitment may happen on account of failure to meet the payment obligations by that party. Means, what do you mean by this third part? Third part means, suppose if my bank is giving the guarantee and if that other party does not perform, then my bank will have to pay, isn't it? So that's known as bank's commitment may happen. May happen means crystallization. This is called as crystallization. When the risk which you have just given in words, when it comes for payment, that is known as crystallization. So answer is A, D. Okay. Which of the following statements is correct? Always check the question. What do they want? Correct or not correct? Okay. The funding risk may arise from the need to replace the net outflows due to unanticipated withdrawals of deposit. Unanticipated. Funding risk means what? Funding risk means I may not have the regular funds which are required for my regular payments. Why? Because unanticipated withdrawals. All the customers of the branch come for withdrawal of money. All of them. So that is unanticipated withdrawal. This happens when, what is this term called as? When all the customers come to withdraw the money in the bank. All the customers. That is known as, one concept is there. That is known as what? Anyone? It is what? It is called as run on the bank. This is the important term, run. I'll write it over here. Run on the bank. Run, or they call it bank run. That's simple. Bank run. Okay. So this funding risk may arise due to this. Let's see. The time risk arises when the performing assets turn into NPS. So my performing assets become NPA. So time risk means what? On the required time, I may not get the payment. On the required time, I may not get the payment. So that is time risk. Call risk arises due to crystallization of contingent liabilities. Just now we saw it. First earlier question. If I give you a guarantee, let's say this is a bank. Okay, bank is it is having one customer, contractor. Okay, now this contractor wants some road, state government. It wants some road contract from state government. So state government will ask for guarantee. Okay, so bank gives the guarantee. Now this contractor does not build the road. Okay, does not perform. Then the state government will ask the bank for payment. So bank will have to pay. This is known as crystallization. So this is, which of them is correct? Call risk arises due to crystallization of contingent liability. That is also true. So the answer is what? Call risk, time risk and funding risk. What is the answer? Isn't it? It's all of these. All of these, right? That is the correct answer. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CIB from IIB. Number one, there are two things which you will be getting. But first is this updates. Now, what are the updates? Updates can be like, for example, change in venue on the last moment, change in the date of the exam on the last moment, some change in the portion, last moment, type of questions change, last moment. IIB gives regular updates, okay, at the time of exam. So for that, you should follow this Officers Adda 24/7 YouTube channel. You get it over here. So first one, updates, you get updates. And second is free YT series, YouTube series. Okay, second is YT, free YT. Right now, what are you watching? Free YT series. Right now, you are watching the same free YT series, YouTube, right? So similar YouTube series, you get it on all the subjects. Okay, so that's why subscribe to this channel, click on the bell icon. How to do this? See this. We have 3 to 4 channels. I would suggest you join all the channels. One is on Telegram. Scan this blue code. Scan it right now. One is this black code, that is for YouTube. Okay. Then third is Instagram. Scan this Instagram code also. And there is one more. That is WhatsApp channel. Nowadays WhatsApp channel have started. Do you know? How many of you know that WhatsApp channels have started? Type in the comment section yes. How many of you know that WhatsApp channels have started? In the comment section, type yes, everyone. How many of you know this? WhatsApp channels have started. Do you know it? So, yes, WhatsApp channels have also started and we are already there on WhatsApp, okay? So just type Adda 24/7 on WhatsApp and you will get it, okay? Next one, the features of interest rate risk are, it is an exposure on the bank's financial condition to adverse movements in the interest rates. So exposure on the bank's financial condition to adverse movement. So exposure for adverse movement. If the things are going against me, then it's an interest rate risk, obviously. If the rate of interest is going against me, then it will be a risk. If it is going in favor of mine, then no risk. Isn't it? It has no effect on the net interest margin. No effect. Okay, it has no effect on NIM, net interest margin. What is NIM? What is the formula for NIM? Everyone type in the comment section. Do you know what is NIM? Formula for NIM in the comment section. Yeah, it is NII. NII divided by NII divided by assets, performing assets you can call it, or just call it assets also, it's okay. Performing assets, that's the right word. NII upon performing assets. Now what is NII then? NII means this interest, I'll just write it short. Loan interest which I get. Here, loan interest I receive minus this deposit interest. So that difference is known as my NII. Okay, that is my income, isn't it? This is my income of the bank. How does the bank earn? Bank gives loan and gets interest, and takes deposit and gives interest. The difference is the income. So that is NII. This NII, when I divide it by the performing assets, I get NIM. So no effect on the NIM. It may attract, it may not affect the market value of the equity. It may not affect the market value of the equity and all of these. What is the answer? All of these? Because all the answers earlier were all of these, and that's why this also all of these. Don't follow this concept in your CAIIB. CAIIB is not all of these, none of these. It's not compulsory that these answers will be there. The correct answer over here is A. It is an exposure to bank's financial condition to adverse movement in the interest rate. It has an effect on NIM. It may affect the market value of the equity. Okay, that is the point, correct one. Which of the following is not a mismatch risk? Mismatch means what? Mismatch. Let's see. Okay, and we want not. Okay, this is your important question. Not a mismatch risk. Holding assets and liabilities with different maturity dates and amount. So assets and liabilities with different maturities means I am having deposit of 1 year and loan of 3 years against that deposit. Okay, deposit of 1 year for 1 lakh, let's say 1 lakh, and I am having a loan for 3 years for the same 1 lakh. So it will be a mismatch. So I want not a mismatch. Is this a mismatch? Okay, just type in the comment section yes or no. Is this a mismatch? Holding assets and liabilities with different maturity dates. Is it a mismatch? Yes. So it is true. I want false here, not. I want false. So this is true. Now what about the second one? Adverse movement in the interest rate. So adverse movement. Okay. So adverse movement in the interest rate means due to the loans and the deposits. If the interest rate moves in the adverse movement, then definitely it's a risk for me. Third one, let's see. B, keep it on hold because it can be the answer. When the liability is repriced on the maturity date and this causes variation in the interest rate. Now, is this the point? Means liability this is repriced on the maturity date. So repriced on the maturity date means what? When I am having the maturity, this liability means what? For the bank, what is the liability? Liability is the deposit, right? So this deposit is repriced. If the deposit goes against my favor, if the deposit interest rate has increased, so that there will be a mismatch between the interest rate of the loans as well as on the deposit. So my NIM will affect. NII will be affected, and in further to this, NIM will be affected, net interest margin, right? So this is definitely a mismatch risk. So this is also true. True. This is also true, but I want false. So now we have to check the closest false. All of the above is not possible because these are not the mismatch. These are the mismatch risk. So A and B are the mismatch risk. So all of the above is gone. So which is the nearest one? Adverse movement in the interest rates. So this is not the mismatch risk. Now what is the logic behind this? You'll say, sir, it can be the mismatch risk. Yeah, I have told you it can be. But I'll tell you how to explain this. See this. If loan, look at this, everyone pay attention. Loan, okay, and second is deposit, okay. Now, if my loan rate is, let's say 9%, and my deposit rate is, let's say 7%, then what is my NII, net interest income, NII? My NII is 2%, 9 minus 7, 2%. Now, imagine both of them go down. Both of them decrease. So both of them become what? 8%. And this becomes 6%. Same proportion. Then also my NI is 2. Okay. So that's why it is said over here, adverse movement of the interest rates is not a mismatch risk because it is happening in both of them. Now, if it happens in one of them, means this decreases but this does not, or this decreases, this does not. In that case, that is called as a basis risk. Basis. Okay, in basis risk, then you'll be having the mismatch part. But here is anything mentioned about the basis risk? No, it is mentioned adverse movement in the interest rates. So it is for both. So that's why this is a false answer and it is not a mismatch risk. Okay. What is the yield curve risk? When two different instruments maturing at different time horizon for pricing assets and liabilities. So different instruments maturing at different time horizons. So that is the yield curve risk. Yesterday I had given the details about this yield curve. Follow yesterday's video. there may not be parallel movement in the interest rate of both the instruments. That is also true. Means 10 years bond, here example, 10 years bond will change in different proportion, whereas to 1 year bond will change in different proportion, interest rates. Okay. Non-parallel movement in the yield curve may affect the NII. So that's also true. Non-parallel movement means this is changing differently, this is changing differently. So net interest income will be affected. So the answer is all of the above. Okay. Yeah. So now everyone, before going, join our Power Pack revision batch for the CAIIB November exam. Okay. All the numericals are covered, objective questions, case studies, all the compulsory subjects, all are covered. You can join the Mahapack also. In Mahapack, you are getting multiple batches plus ebooks plus tests. Okay. I'll show you how to join this. Go to Adda 24/7 here. I'll always suggest you to go through the app. In the app, you get coin systems. Using that coin system, you'll gain around 1% extra. So now what is going on right now? 80% off is going on. But if you use the app using the coins and you go on collecting the coins, then you'll be gaining 81%, 1% extra. Okay. So go to Adda 24/7, click on JIB and CAIIB, click on CAIIB November 23. Click. Now you'll see this promotion batch. Okay. This Power Pack revision batch. Click on this revision English batch. Okay. See this. All the 4 subjects are covered. You can see the ebooks, videos, test series. Click on the ebooks. You'll see subject-wise ebooks. Click on this subject-wise, each subject. You'll see chapter-wise ebooks. Okay, so things are to that level. Chapter-wise questions are given. Plus test also. Click on this test. You'll see this prime pack. Click on this prime pack. It's a part of this only. Okay, it's a part of your test series. So you'll see mock tests. Module-wise mock tests are available. So at that level we have gone. So that's why it is the most beneficial for you. In fact, I would suggest, and look at the fees, 80% off. Okay, Joy 80 code. It's already applied. See here, click on buy now. See this Joy 80 code is already applied. 80% off is already applied. If not applied, then you can just apply it. Click on continue. Fill in your details, full name, phone number, email, and make the payment. That's it. So immediately join the batch. See, just now the batch is started and many more topics are yet to come. So that's why join it. And also, as I told you, Mahapack. Click on Mahapack. Join the Mahapack. Look at this. In Mahapack, JIB, CAIIB, Mahapack. You'll see this. See this. CAIIB Mahapack 2.0. Click on this. Now you are going on with double validity. Now double validity means what? 80% off you are getting, obviously. But along with it, you are getting double validity for the 6 months and 12 months package. So for you buy it for 6 months, you get it for 12 months. You buy it for 12 months, you get it for 24 months. Okay, so double dhamaka, double validity plus 80% off. Again, ebooks are available, videos, test series, everything is available. Expert faculties, interactive classes, recorded videos. What all do you want? So join fast. Okay, I'll be back tomorrow with another series. Till then, keep studying and join the batches ASAP. Okay. Friends, welcome to Adda 24/7. We are in the Sankalpa series for MCQs. Not only MCQs, we are covering numericals, objective questions, theories, case studies. All of the 4 we are covering. So today we will be covering the liquidity risk. See here, objective questions on liquidity risk in treasury. Important part, this module C, BFM. Okay, today we will be covering that. So let's start. Here, one thing I'll tell you, follow the series completely because various questions are covered over here. If you follow it part by part, so today you follow it, tomorrow you don't follow it, then you will miss out on the important lectures. Okay, so let's move on. Today we will be doing the objective questions. I'll be asking you the questions and explaining you as well. Not only I'll just ask you or give you the answers here. Answers are not that important. Explanation is important. Answers you can definitely get it in the books also, right? Which of the following foreign exchange operations have been useful in treasury management operations? Which of the following foreign exchange operations? So which of them foreign exchange operations have been useful in treasury management? Arbitrage, swaps, A and B both, and none of these. Now I'll tell you one thing. Firstly, give me the answer. Then I'll give you where are the loopholes. Type the answer. Is it capital A? Let's mark only this. A, B, C or D. What is the answer? Many of you have answered this C correctly. C is the answer. Right? But before going ahead to the next question, C is the answer, agreed. Have you understood what is arbitrage? Have you understood what is swaps? If you have not understood it and you are just typing, you have heard some word about arbitrage, you have heard some word about swaps, and you are saying, yeah, in treasury they are used, so I'll take both A and B. No, no, no. Don't do that. In BFM, you need to understand the things. That's important. Okay. What is arbitrage? Arbitrage means buying from one market and selling it to another immediately. For example, I'll give you a simple example. We see that sabji wala, vegetable vendor, vegetables. The one who comes on the road near our house. Sabji le lo, bhaji le lo, right? That Nana Patekar, you remember in that movie, No Entry? Aloo le lo, what gobi le lo, that sabji wala. What does that guy do? That guy does this arbitrage. What does he do? He buys it from the dealer. Dealer means distributor. Dealer. And immediately same day sells it to the retailer, means retail customers, to us. Let's call us only customers. Okay. So what does this distributor do? He buys it from this dealer and sells it to the customer on the same day. Okay. So today, if we today morning, generally this vegetable market is in the morning between 4 to 7 a.m. in the morning. Okay. There the whole wholesale market works. And after 7 a.m. this retail market works. So this guy buys it over here from the market on the same day, day one. Let's say D1 only, day one. And this guy sells it to the customers on the day one only. See here, vegetables can't remain for the next day. These are perishable items. Tomorrow if somebody comes to sell you today's vegetables, immediately one can recognize that these are old or stale vegetables. So that's why this guy has to purchase only that amount which he can sell today. So that is arbitrage. Buying in one market and selling it into the other end, earning the commission on this. Similarly in BSE and NSE also. Suppose if there is a Reliance share. Okay. I buy it on NSE at let's say 2500. And immediately I sell it on BSE. Suppose there is a gap, price gap between these two exchanges for let's say this happens hardly for 4 seconds. 4 seconds. So there is a gap of 2500 over here and it is 2503. 3 rupees gap is there. So what will I do? I'll buy 1 lakh shares over here and sell 1 lakh shares over here. So what have I done? I want 3 lakh. 1 lakh into 3. 3 lakh. In how many seconds? 4 seconds. That is arbitrage. Safest. Okay. Swap means what? Swap is different. In swap, always remember, I'll just give you one basic over here for swap now. In swap, always there is one leg which is fixed. One leg that is fixed and other leg that is floating. Okay, floating. One leg is fixed, other leg is floating. For example, if I take 1 lakh rupees from you, 1 lakh, okay, and I guarantee you 7% rate of interest. So this is what fixed. I am guaranteeing you 7%. Okay, so this is going out. This is minus, right? For me, it is out. So I am guaranteeing you 7% rate of interest. So this is fixed. And what do I do with this 1 lakh rupees? I invest it, let's say, in the stock market. Stocks. Now these stocks can give me, either they can give me 50% returns also, right? Or they can give me 0% returns also, or minus also, minus 50% also. Anything can happen. So this is floating. So in swaps, always remember one leg is fixed and other leg is floating. Okay. So that's why the answer is both A and B, and these both the operations are used in forex as well as in the treasury bonds also. Risk in trading securities may arise from the following. So trading in securities may arise from what? Now this is a very simple answer. Trading in securities may arise due to what? Number one, foreign exchange transactions. Second, equity holding. Third, lending and repos, and all of these. So trading securities may arise because of what? This forex. Definitely, if the rate of the dollar goes up or down, definitely that will affect it. Equity holding. How much equity I am holding? Equity holding means what? Suppose if I am holding the shares of, let's say, Infosys, Reliance, TCS, all these companies, that is my equity holding. So if it goes up, share market goes up, stock market goes up, I'm benefiting. If down, I'm losing. Lending and repos. This is basically related to bonds. Remember, lending and repos mean, repos are the, what do you mean by repo? Everyone. What is a repo? Repo is the rate at which RBI lends to the banks, right? RBI gives money to the banks at repo. Remember, this repo is traded in the market. Traded. You'll say, how can it be traded in the markets here? Repo is what? RBI has given you money at this rate. Okay. So if tomorrow after 6 months, or let's say after 3 months, the repo rate decreases, then it will be this, the rate at which it was given earlier is at higher rate. Let's say it is, let's say 5%, example I'm giving you. After 3 months, it becomes, let's say 4%. So the one who is holding the 5% repo will be at an advantage. So that's why it is traded. So here, trading is done wherever there is a gap in the interest rates. Trading is done everywhere. So the answer is all of these over here. Okay. Which of the following is not an agency service of the bank? Agency service. Agency means what? Here the bank is acting as an agent. Agent. Agent means what? LIC agent. Remember this? LIC agent. Insurance. Or any other agent also. Means mutual fund agent. What does the agent get? Agent gets only commission. Same thing, bank also gets only commission in agency services. So which of them is not the agency services? Extending credit, escrow, merchant banking services, and insurance selling. So which of them is not the agency? Not. They are not acting as the agents. Now very easy one but tricky one. You can immediately see the answer. Let me see how many of you can answer over here. Correct. Extending credit. It is not an agency commission over here. It is the core business of the bank. What is the business of the bank? Basic business of the bank, right? Deposits and loans. So extending credit is a basic business. Escrow, merchant banking services, insurance, and these are all agency services. Okay. Escrow will take a lot of time. Otherwise, I would have explained you. Escrow is actually, I'll just give you one liner. Escrow is a temporary account. When two parties don't trust each other and they have some funds in common or something in common. This is generally done in road contracts by large companies, or even two buyers and sellers in different countries. If they don't want LCs, okay, they don't want the cost of LCs, so they use this escrow account. Temporary accounts, yeah, the funds are kept in the bank account, right? And it can be taken by, means it can be withdrawn by the sign of both. Okay. It's like a joint account. Okay. So escrow account is that. Merchant banking services, again, one liner only. Merchant banking means basically whenever you have that IPO, right? Reliance IPO, TCS IPO, all these IPOs. There the services are given by the bank as merchant banker. And insurance selling, you know. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we require, you get it over here. So that's why download it right now. Okay. And don't just download it. Start studying also. Otherwise, how many apps do you have in your mobile? How many apps do you have in your mobile? Can you even tell me the number of apps? Not possible. My second question. How many apps have you actually used in last 1 week? How many apps have you actually used in last 1 week? I'll tell you. WhatsApp, right? WhatsApp is the app you have used. Some banking app you might be dealing with, any bank, right? If you are dealing in shares, then this app of this DP, right? Then what? Nothing else. That's it. And some YouTube and all these things. So that's okay. So we don't use the apps that much. We just download them and keep it for some time, and that sometime never comes. Same thing should not happen with this app. Download it and start using it on a daily basis. Okay. What is off balance sheet risk? Off balance sheet, which is outside the balance sheet. Off balance sheet. Okay, it is contingent in nature. Means contingent means what? It is not for present, but it may come in future. It can occur on account of issue of guarantees. So guarantees is what? Again contingent, come in future. Right? Bank's commitment may happen on account of failure to meet the payment obligation. That can also be possible. Means when I issue the guarantee, what does it mean? I'm telling somebody, if this guy doesn't work, I will pay you, whatever your losses are. So actually, if this guy doesn't work, then what? I'll have to pay it. So that's why it may get converted into cash, and this is known as crystallization. Crystallization. Crystallization means crystallization means converting the contingent liability into real liability, means cash flow liability. So the answer is this. Oh, let me get it from you. So what is the answer? Contingent, guarantees, crystallization. What is the answer? Off balance sheet. It is D. All of the above. Correct. All of them are the off balance sheet items. None of them is of the on balance sheet items. What is the off balance sheet item? Off balance sheet item means here I don't pay cash right now. Right now I don't pay cash. That is off balance sheet. Balance sheet item means what? There I pay the cash. CC, term loan, I am paying the cash. Guarantees, I am not paying the cash. Okay. Which of the following statements is correct? Now I want the correct one. Okay, correct. You should always mark what is required in the exam. Correct or non-correct. True or false. Whatever. Okay. The funding risk may arise from the need to replace the net outflows due to unanticipated withdrawals of the deposits. So, net outflows, whatever outflows are there due to unanticipated withdrawals, everyone is coming for withdrawal. So, you'll definitely face the funding risk. There won't be any money, right? If everyone comes for withdrawal. So, is this correct? Yes, A is correct. What about B? Now, I want to answer from your side now. Time risk arises when the performing assets turns into NPA. Is this true? Time risk, what is time risk? Let me explain you, but I won't be answering this now, whether B is correct or not. That is what you should answer. Time risk means what? It's a part of liquidity risk. Here in liquidity risk, I don't get money on time to pay for my liabilities. That is time risk. Now tell me whether this B is right or not. When asset turns into NPA, means my performing asset becomes NPA, then I won't be getting the interest, whatever that asset was going to give me, loan was going to give me. So that's why it is again 2. So if 2 are correct, obviously this answer will be D. Let's see the third one also. Call risk arises due to crystallization of contingent liability. Just now we saw. Crystallization of contingent means what? If I give the guarantee on behalf of somebody, and that person does not perform. So in that case, what happens? If that person does not perform, then I'll have to pay for the losses of that third party. Isn't it? So when I have to pay for this is called as crystallization, and this is known as call risk. Okay. So third is also true. Okay. This is also true. So the answer is all of these. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting number 1, free YT series on all the subjects, and number 2, latest updates from IIBF regarding the exams. They give various notifications. This timing change, that timing change, this portion added, that portion added, something, everything. Okay. The features of interest rate risk are interest rate risk. What is interest rate risk? Interest rate risk means the interest rates may go up or down, depending on what the RBI is doing or whatever this foreign situations are, means world situations are. So that is interest rate risk. It is an exposure of banks' financial condition to adverse movements in the interest rates. Financial condition to adverse movements. Here, adverse movement means against your will. means against your wish, you can call it. Okay. So is it that? Yes, it is that. What about the other one? Second one you give me. It has no effect on net interest margin. It has no effect on NIM, net interest margin. I know many of you have typed this answer D now. D. I am seeing D answer. All of these. But remember, all of these, D is, we generally have the tendency of marking all of these, none of these, either A or B. We have the tendency of marking them as an answer, but it's not always correct. Okay. So here B, it has no effect. That is wrong. It has an effect. Interest rate risk will definitely affect my NIM. It may not affect the market value of the equity. That is also wrong. Market value of the equity means whatever is my stock price. If I am facing an interest rate risk, immediately the stock market grasps it and knows it that yes, I am facing the problem. Immediately my stock price is affected. So answer is only A over here. Okay, only A. Which of the following is not a mismatch risk? Mismatch. What is the mismatch? Mismatch means assets and liabilities mismatch. Okay, not. We want not, but not a mismatch. Always focus on what is required in the exam. Okay, holding assets and liabilities with different maturities and amount. Is it not a mismatch risk? Liabilities I am having for 3 years. Assets I am having for 1 year. Is it not a mismatch? Yes, it is a mismatch. So I want not a mismatch. This answer is true. I want a false answer. This is. What is my requirement? F. This is my true. T. Adverse movement in the interest rates. So is it not a mismatch? Adverse movement. Yeah. See this. Let me see the answer from your side. What is C? When the liability is repriced on maturity date and this causes variation in the interest rate. So what is this? Firstly, tell me about B. Adverse movement in the interest rate risk. Is it not a mismatch or is it a mismatch? It is a mismatch. Why? Because adverse movement in the interest rate risk will definitely affect me. For let's say same case, asset for 1 year, liabilities for 3 years. If the interest rate moves in adverse directions, it will definitely affect my asset and liability positions or my net profit over here. What about the C? When liability is repriced on the maturity date, this causes variation in the interest rates. So, when liability is repriced, see this is known as repricing, reinvestment risk, repricing risk. So, this is not a part of mismatch. This is false. This is a reinvestment risk. Okay. How to join the Officers Adda 24/7 YouTube channel? Either YouTube or you can join the LinkedIn using this blue. Scan this QR code right now. Scan this black QR code right now for YouTube. This blue one for LinkedIn. This third one for this Instagram. Join immediately. We are giving various free YouTube series, various questions, various tests freely on that. What is the yield curve risk? Yield curve. Yield curve means it is yield. What is the yield? Yield means basically what are the returns I am getting from the bond. Formula is very simple. Coupon upon price, right? Into 100. Of course, everything is into 100 only. So this is yield. What is the yield curve risk? When I plot this yield for various maturities, here this is time. Okay, various maturities I plotted. So if I plot it for various maturities, okay, then the various the curve which I get is known as the yield curve. So when two different instruments maturing at different time horizons for price, assets and liabilities, so that is basically yield curve risk. So A is right. There may not be parallel movement in the interest rates of both the instruments. Means let's say this is 3 months bond and this is 10 years bond. So both of them will move differently. So that is also true. So once you get A and B as true, the answer will be all of these. Okay. So look at the third one also. Non-parallel movement in the yield curve may affect the net interest income, obviously. And net interest income will be affected if 3 months moves faster and 10 years move slower. So it will be definitely affected, isn't it? So that is again a yield curve risk. Got it, everyone? So what is the yield curve risk? Everyone has got this? Okay. Now take one for the homework. Which of the following statements is correct regarding the yield curve risk? Now I won't be answering this. You get it from your side. Tomorrow we'll see it. A bank needs to evaluate the movement in the yield curves and the impact on the curve on the portfolio value and the income. In the paid class we'll say this. Okay. I'll give the answer in the paid class over here. If the liability is raised for 364 days T-bills and is used to fund on the asset for 91 days, it would yield to the yield curve risk. And both end. Check this answer. Okay. I'll be back tomorrow with another series. But so now friends, before going, one important thing never to be missed out. Join our revision batch going on. Join fast. Okay. Click on CAIIB and CAIIB. Click on CAIIB November 23. Now I'll show you the details. What all do you have in this? English batch. CAIIB Power Pack Revision Combo batch. Okay. Click on this. You will see all the 4 subjects. ABM, BFM, ABFM, BRPL. All of them covered. Numericals, objective questions, case studies, everything covered. Test series, ebooks, videos. Click on these ebooks. Look at this. You are getting ebooks also. Click on these ebooks. You will see this chapter wise, subject wise ebooks. Click on any of these subjects. You will see chapter wise ebooks. Similarly, test. Click on this test series. You will see prime pack test series. Click on this. You will see various mocks, right? So click on this. You will get the mocks. Means pay this and you will get unlocked over here. So that's why join this test. Join this this Power Pack Revision Combo batch immediately. Okay, you can join the Mahapack also, and importantly, 80% off is going on. Joy 80 code. Click on this buy now. Then you will see the fees. See this 80% off. 14,999 reduces to 2,999.80. Click on continue. Fill in the details, full name, phone number, mobile number, email, and that's it. Make the payment. That's it. Okay. Then similarly, you can join the Mahapack also. In Mahapack, you get multiple batches. Let me show you. So this. Go to again the front page. Say this CAIIB Mahapack. Click on this Mahapack. Now you will see double validity going on the Mahapack. Double validity means you buy it for 6 months, you get it for 12 months. You buy it for 12 months, you get it for 24 months. And same thing, test series, ebooks, videos, click on them, you will see chapter wise, expert faculties, interactive classes.